So, as the Federal Reserve continues to cut rates going into 2025, home prices will likely go up in the coming months. And unfortunately, home affordability will continue to be an issue because people who have a 2% or 3% mortgage rate will most likely stay where they are unless they have to move or they have the cash to purchase their next home. And I don't think the home prices will crash like many other YouTubers say, but they will likely go up in 2025 and 2026 as interest rates continue trending downwards. But also at the same time, don't think that the mortgage rates will come down as fast as you think. The mortgage rates could price in much sooner than the Federal Reserve cutting interest rates. So the rates could remain elevated. If you look at the US housing market, the overall median sale price was 433,000 in August 2024, and it has slightly cooled down right here from at the peak at 442,000, but it is still unaffordable for the majority of Americans. If you look at January 2024, right here, it was about 402,000. The problem is inventory, right? And like I said, people with 2% or 3% mortgage rates will most likely not sell their homes, because why would you sell your home now to get another mortgage for 6 to 7%? Roughly 86% of existing mortgages have rates of 6% or less. So when the mortgage rates drop below 6%, it's going to increase demand for homes. And with a limited supply, we're going to see these home prices go higher. And Goldman Sachs is forecasting home prices to grow by 4.4% in 2025, while Fannie Mae is predicting a 3.1% increase. Personally, I think it's going to be even higher, unfortunately. And I think it's going to depend on the rate of the mortgage rate drop and the rise for demand. And it's also going to depend on the location as well. And if I sort this by single family homes here, the median sale price is actually a lot higher at 453,000. And this is with a 5% decline in homes sold year over year and a national average of 30-year fixed mortgage rate at 6.5%. So more Americans are delaying their first-time home purchase because now they need to save more for the down payment. If the median home prices rise to $500,000, hopefully not, by next year, even with a 3% minimum down payment, it would cost you $15,000. If you're looking to make a 20% down payment, that's going to cost you $100,000, right? I'm not saying that this is going to rise to $500,000. I want to make that clear. I just use that number because it's easier for me to talk numbers. Anyway, now there are two additional scenarios in which mortgage interest rates could continue to drop as the Fed continues to cut interest rates. First, I want you to pay attention to the latest inflation rates. When we get the PC inflation and CPI between now and the next Federal Reserve meeting, and we see further inflation drops, rates on borrowing products could also start to fall. And second, lenders could preemptively start cutting mortgage rates if there are signs of easing inflation. So the bottom line is that we could see the mortgage rates drop significantly more even before the next Federal Reserve meeting. So right now, I believe that the mortgage rates are already priced in for today's interest rate cut. But don't be surprised if these home prices continue to rise when they cut the rates, because the demand to buy homes will also surge. Now, take a look at the housing supply side, okay? Right here. And if you look at how many homes got sold over the past 3 months, people are still buying homes left and right. And if you look at the number of newly listed homes, it is still 2.4% less than the year before. So again, supply is going to be an issue for a while. With more buyers competing for a limited number of available homes, home prices are likely to rise in the coming months. And remember that a lower mortgage rate reduces the cost of borrowing. Home builders will get a better interest rate on their construction loans to build more homes, but that's not going to be fast enough to build up the inventory. Home buyers will also see that the interest rates have dropped from, let's say, 7.5 to 6.5% and possibly to 5.5% or maybe even lower than 5%. This will bring down their monthly mortgage payments, which will make borrowing money much cheaper than the year before. The supply and demand will also depend on the area, the housing market in, let's say, Tampa in Florida. And if you didn't know this, the mortgage rates generally follow 10-year treasury yield. And during an economic stress, you can see the spread between the two widen, okay? And I'll save that for a separate video for another day. So be sure to subscribe if you haven't done it already. But anyway, a decline in mortgage rates will also help the sellers because they'll be able to raise their home prices, which help them get more equity of their homes. And according to the St. Louis Federal Reserve, US homeowners right now have more than $32 trillion in home equity, and 60% of homeowners have at least $100,000, while the average borrowers sit on roughly $214,000 in equity. Let me know in the comment section down below how much equity you have in your home. By the way, I am so fired up to announce the launch of my private FIRE community for people just like you and me who are passionate about investing, saving, and achieving financial independence and exploring different possibilities to retire early. My private community will allow you to connect with me on the platform and get in touch with other like-minded individuals or couples who are just as serious as you are with the FIRE movement. As a member of my private community, you'll get resources like investing, saving, paying off debt, or finding the right place to grow your money. In my opinion, there could be a surge in demand like we saw in 2020 and 2021 when the Fed funds rates, let's say, come down to about 4%. Just ask anyone who's been looking to purchase a house or an investment property. They're going to be happy to see anything below 5% or maybe even 4% at this point, okay? And no matter what you're doing, you need to make sure to do the following before you buy a house. You need to first make sure that you are completely out of high interest debt. And this is the common mistake that I have seen with people I have talked to, people I have consulted in the past. That includes your credit cards, personal loans, and anything else that is going to hurt your cash flow. You don't want to worry about your debt repayment when you add another large debt to your balance sheet, right? And the second thing you need to have at least, this is what I recommend anyway, that would be the 6 months of bare minimum expenses. And how you calculate that will really depend on where you're gonna live. I usually just 6 multiplied by my mortgage payments and multiplied by other utilities, transportation, all that stuff too. And that should be sitting in a high yield savings account labeled as an emergency fund. I can't tell you how many times I had to repair my home because something broke. I had 2 toilets broke on me. I had 1 toilet break upstairs about a month ago, and then the toilet bowl just cracked downstairs and it just flooded the entire house. That was a pain. And they can cost hundreds, if not thousands of dollars to, let's say, repair the HVAC unit, fridge, washing machine, garage door, and many more. And then the next thing you need to assess is how much home you can actually afford. And I've been following the rule of 25 for a while. And that's to maintain my mortgage payment at 25% of my income, okay? So when people ask me, how much can I really afford my home? Well, is it 25%? You know, if I make $5,000 a month, then my mortgage payment should not exceed more than $1,300 a month. And I know that sounds insane, but math is still math. I can just hear the comment section go crazy with what I just said because of the home affordability. But if you go above 25%, you're not going to have any room to invest for retirement, save for a vacation, or save for anything else that you need or want. If you need a stronger or a bigger down payment, then you need to save for more money. You need to be patient and make sure not to become house poor, because becoming house poor is a real thing in this country. I can't tell you how many people I've talked to in the past who have paid over 30, 40, or sometimes even 50% of their household income towards their mortgage payments. You cannot argue with math. If you have any high interest debt, you're not ready to buy a house. If you don't have enough down payment to bring the mortgage payment down below 25% of your household income, you're not ready to buy a house. I know that's frustrating because the home affordability is ridiculous right now, but math is still math. And lastly, if you don't have enough cash set aside to be ready for any home repairs, you're still not ready to buy a house. Be different from the mistakes other people made. Be smart about buying a house because it is an expense, not an investment. All right?